What's good, y'all? Welcome back to the channel. I'm just dropping in to give you a quick portfolio update because I have made a major change to my holdings. So I'm going to get right into it, let you know what that change is, and give you my reasons behind why I made that change. So as you can see, I have a new holding, which is Western Midstream Partners, and that holding has replaced Dow Chemical. So Dow is out, Western Midstream is in. I'm going to give you, I touched on it in the last video I made, but the reason why I got rid of Dow was simply because it does not grow its dividend at a pace that's higher than inflation. In fact, Dow does not grow its dividend at all. It was a spinoff. Dow is a spinoff of Dow DuPont. I think the spinoff occurred like 5 years ago. Over those 5 years, it has not increased its dividend. Its 1 year, 3 year, and 5 year dividend CAGR or CAGR, however you want to say it, is zero. I am a dividend investor who wants to eventually live off the income from this dividend portfolio. So if the dividends in my portfolio are not being grown at a rate that's higher than inflation, I'm just cannibalizing my portfolio. Eventually, my income doesn't matter if you're making 100,000 a year from your dividend portfolio. If inflation has made 100,000 worth 10,000 over time, so you want to make sure, which is a key tenet of my investing strategy, is that on average, a company can go through problems where they may have to reduce the amount that they increase their dividend by. That's fine. But when I look at that 3, 5, 10 year CAGR, the averages have to come out to be above what inflation is. That's just going to be one of my key tenets of investing going forward. So any company that does not grow their dividend at a rate higher than inflation is automatically not a company that is not a company that I'm going to be investing my money into. So that's why Dow had to leave. I actually waited. I sold those Dow shares at a loss of about $1,000. It actually bumped up like 5% in a day to like 30 something a share from the 20 whatever it was at. That's when I went ahead and made that sale. I think I'm going to look more into tax loss harvesting, see if that's something I can kind of make up on the back end. I just don't know about that. I got to do more research on it. I'm pretty new, like I said, to investing, so I got to look more into that. But just a little bit of background as well. I'm going to be making the energy sector is where I'm going to be putting the bulk of my money for the foreseeable future. I want my portfolio to be diversified, but I want to build up, certain positions. So it'll be pretty heavily weighted in these midstream and energy producers, for the next couple of years, because I don't see the purpose of having of stringing out 30 or $40,000 in 20 or 30 positions. I might as well go ahead and build up that concentration early in positions that I feel confident about, in companies I feel confident about, instead of trying to have like a huge portfolio in such a short amount of time. It just doesn't make sense to me. My portfolio will be diversified, but it will go through periods where there's going to be, concentration in one sector, concentration in two sectors, concentration in three sectors, as I'm building it out to the my target range is about 20 to 25 total companies to hold in this dividend portfolio. It could be more, but that's my target. It's about 25. I think 25 will offer me a decent amount of diversification within my portfolio. But I'm going to go ahead and get right into it. Some of the reasons why I like WES. WES is the ticker for Western Midstream. A big reason is the yield. It is a pretty high dividend yield. This is actually the highest dividend yield, the highest dividend payout, 91 cents a quarter, in Western Midstream's history so far. So this is I believe they raised their dividend by like 50% this last year, so like a 50% CAGR. Do keep in mind, with Western Midstream, they did go through two dividend cuts. So one in 2020 was a COVID reduction. I don't hold those COVID reductions against any company. If you were a company and during COVID you kept your dividend the same, or you raised it, that's just a plus to me. But I don't hold those cuts against any company. COVID was an unprecedented time, so the way they handled it was, at least in my lifetime. I'm not that old, but I don't think it's ever. It's a black swan event. I don't hold it against any company. Now, 2015, they did also reduce their dividend. 2015 was an oil crash. The dividend was reduced at that time as well, but I believe those are the only two times that the dividend has been reduced in this company's in Western Midstream's history. So kind of keep that in mind. I also want to say that I don't plan right now. I have about $3,500 invested in Western Midstream. I don't plan on adding any more money to this company. I'm just going to let the dividends reinvest on itself and compound uh, with the dividends that are going to be paid out to me. So I have the drip on for this company for Western Midstream. I'm just going to let it compound in on itself. I probably will add like a little bit to it if there's like a major pullback within these midstream companies, but for the foreseeable future, I'm going to be just letting the dividends kind of buy me some more shares. I will be adding now going forward primarily to EPD. EPD has a much stronger balance sheet. There are several other midstream companies with a stronger balance sheet than Western Midstream, but their dividend isn't as high. So just kind of it's just your risk tolerance. I know that that's a pretty high dividend yield. There, some people feel a certain kind of way about that. It's fine with me as far as my MLP that I'm going to be holding. Western Midstream will have the smallest amount of cash as far as the position goes for the amount of MLPs I plan to hold. I plan to hold three. Western Midstream's one. Enterprise Products Partners is another one, and I'm looking and strongly considering MPLX. I just have to do some more research on it and just need more research on it. But I more than likely will be adding MPLX as my third midstream company that I'm going to be holding in the portfolio. But like I said, the dividend yield that's one attractive part of Western Midstream. They're the management has stated that they're going to be growing the dividend at a low to mid single digit CAGR over the next couple years. So I'm assuming that's going to be anywhere between a 3 to 5% CAGR over the next over the next years, which is good with me because you're starting out your dividend. Your starting yield is almost 10%. So a 4% raise a year on 10% on a 10% yield is a plus in my book. So a couple things about Western Midstream. They're not the largest midstream company, but they're also not the smallest. They operate about over 14,000 miles of pipelines. They also have gathering systems, processing and treating facilities, just like all the other midstream companies as well. They primarily operate in Texas, Wyoming, Utah, and New Mexico, with their major operations in the Delaware and DJ basins. I believe those two basins are in Texas and New Mexico, if I'm not mistaken, and then the Powder River Basin, which I believe is in Wyoming. I'm pretty sure it's in Wyoming. So those are their primary areas of operation. They operate mainly in that Midwest region. So I think that's where the Western Midstream portion comes in their name. But they have other operations in other places as well. But that's their primary geographical location that they operate in. And like I said in the previous video, I like companies that reduce their debt. And in 2024, Western Midstream sold assets worth about $800 million and used that to reduce the debt that they have. So that was also a plus for me that always kind of piques my interest. Companies that are paying down their debt. Another thing I like about Western Midstream is that 90% of their contracts are fixed fee based, which means that they're not too affected by commodity pricing. So if oil is $1 or oil is $100, it shouldn't matter. Based with these fixed fee contracts, the oil that they produce should yield them the same amount no matter what. So the amount of money that they make on those transportation costs when they transport those liquids, those natural gas liquids, the oil, just the natural gas itself, it should not be going up or down based on the price of those commodities. So that's another thing I like. It's just the fixed fee contracts that they have. What you want to keep in mind when it comes to the dividend though, is that they do pay out currently over 100% payout ratio on the dividend. I think it's like 105% if I'm not mistaken. Now that is also compared to their dividend coverage ratio is 2. So you just kind of that's another reason why I'm not going to make it too much of a large holding as far as cash that I'm going to put in from work into this company because of that payout ratio. I don't like companies that have high payout ratios, but MLPs, I think they're required to pay out like a certain amount of their revenue and dividends. I got to look back into that one, but their dividend coverage ratio is 2, payout ratio 105. So if you don't know what a dividend coverage ratio is, it's just how many times their earnings covers their dividend. So they're saying that their dividend is covered, their earnings are 2 times what their dividend that they pay, and their payout ratio is 105% of their earnings. So you just gotta go. It's kind of confusing a little bit. The more you I know it's kind of like weird. How can your earnings cover your dividend 2 times when your payout ratio is 100%? But it's basically your coverage ratio is just how many times can your earnings cover your dividend. So if you pay out $10 in dividends, that means you have to have a coverage ratio of 2. You need to have $20 in earnings, right? If you pay out uh, $10 in dividends and you have $20 in earnings, that means your payout ratio is 50%. So you just kind of keep that in mind. I do also like about Western Midstream that they free cash flow is growing. So they exceeded their free cash flow guidance for 2024, and the management expects to exceed that free cash flow guidance in 2025 as well. So that's just a short list of things that I like about Western Midstream and why I have it in my portfolio replacing Dow. Also, one other thing I want to say about not just Western Midstream, but the MLP the midstream MLP space in general was that at least for me, well, that's just about investing in general. You just want to approach everything with an open mind, right? That I think you'll get your best results as you go through your own investing journey, whatever that is, if you just approach things with a an open mind. Just a couple you don't know, I also kind of give. I'm also going to be doing some stuff about real estate on the channel as well, but I also do a little bit of real estate investing, not a whole bunch, maybe like a house every 3 or 4 some years. But that's but there was a time when I came across these MLPs during COVID, right? And a lot of times people will tell you that a high dividend yield is a dividend trap or something like that. Well, if you had came across Western Midstream in 2020, their dividend yield was 20%. So you would have been getting a 20% dividend yield locked in and major price appreciation, because I think in 2020 the stock price dropped all the way down to like $10 or $12. Same thing with MPLX, much larger midstream company, much much better, much stronger balance sheet than Western Midstream. Their dividend yield was like 20 or 25% at that time, and MPLX has grown their dividend every year since they've been around. So kind of keep that in mind as well. I'm only saying that about the real estate thing because when I did my first ever real estate deal around that COVID time frame, I was hell bent on renting out the house and being a landlord, but I was getting advice from my dad to sell the house. I could have sold that house for like 40 grand at that time, right? If I would have sold the house for 40 grand, I could have bought just this is hypothetical. It's something to just think about. I could have put that into MPLX, and that would have been giving me what $8,000 $8,000 a year. Well, would have been way more than 8,000. They've been growing their dividend at like a 8 or 10% CAGR, like a 5-year CAGR. So I would have been over $8,000 a year passively, plus that 40,000 I would have put in during COVID would have ballooned to like 60 or $70,000 by now. So just you want to approach investing with an open mind. I remember actually seeing MPLX. I had another E-Trade account. I didn't put any money into it, so E-Trade ended up shutting it down. But when I first started trying to like kind of learn about investing, and I came to me being young, well, I'm still young, but me being younger back in the day, right? A lot of young people fall into that whole like just high yield, chasing high yield, chasing high yield. So I went online and I Googled high yield dividend stocks. I always like dividends, even from when I first started learning about investing. But I went in and I Googled high yield dividend stocks, and I actually came across MPLX. So I came right here in E-Trade, put in MPLX, and in 2020, this price right here was way below. I think it was like, I don't know exactly. It was nowhere near $50 in 2020, and that yields right here. The yield was at like 20 or 25% when I at the time I went in and looked into that account. And at that time, if you when you're young, you're just listening to like talking heads on those CNN, not CNN, but those Jim Cramer. Nothing wrong with Jim Cramer, but all those business news channels and business news podcasts, whatever. You're just listening to them. You're hearing them. All of them are saying that anything over a 4 or 5, 6% yield is high risk. It's a dividend trap. Nobody back then was saying anything positive about anything that had a high yield on it. And it turns out that they were all completely wrong about MPLX. And had I had an open mind and listened to the advice that I was given to sell that house that I had at during COVID, I ended up selling that house, but it was like several years later after COVID had died. After we were past COVID, I sold it in the high interest rate environment that we're in now, and I got like half the money I could have got for it had I just listened, had an open mind. Right, I was hell bent on trying to be a landlord and trying to rent. Only made half of what I could have made on it. Right, and also, even if I had listened and had an open mind and sold that house, would I have also had an open mind about investing in MPLX when I saw that dividend yield, because people on MSNBC told me that you shouldn't be investing in stuff with a high dividend yield. I'm just saying that when hindsight's 2020, but I know I'm stuttering a whole lot. I'm still trying to get more comfortable with this whole YouTubing thing. I'm just trying to get more comfortable with it. But all I'm saying is that, you want to have an open mind when you approach investing. Had I had an open mind about selling that house, just flipping the house, I should have just flipped it. I should not have rented it. I should have just fixed it up, flipped it immediately, made 40 grand, right? I would have came into the stock market with that same open mind, seen NPLX, put my 40, not all my 40 grand. I would have diversified it across, some other stocks, but I would have been hypothetical situation, open mind, sell the house immediately, flip it, take the 40 grand, put it into MPLX. I would have been making like 10 grand a year, and I would have had like 70, 80 grand as far as share price appreciation over these 5 years after COVID. So all I'm saying is just keep an open mind as you go through investing, right? You wanna do as much research and learning as you can on your own, and eventually you're gonna come across a strategy, come across a blueprint, come across something that just intrinsically, like inside it just speaks to you. Dividend investing just speaks to me. I'm not against growth investing. Some people just, they hate dividends. They think it's, they have all this negative stuff to say about dividends. When I came into investing in the stock market, dividends just make sense to me. Mentally, dividend investing helps me and keeps me going forward. Because when I come right here and I click on this income tab, and I see here right now it says I'm going to make $475 over the next year. Every time I go in and I buy a share, this price right here, this income number, it goes up. Me being able to see that go up each and every time I click the buy button motivates me to click that buy button as many times as possible. That's why I have a second part-time job now, and that part-time job is simply all that money goes into me buying more stocks. If you don't know though, I'm a teacher, so I don't work during the summer. So my part-time job like floats me for the summer. And then once I get back to teaching during the regular school year, all the income that I make from that part-time job is only like maybe $100 something, like a couple $100 a month. But all that couple $100 a month goes directly into this account to grow this, in addition to what I'm putting in from my actual like main job, my main source of income, which is teaching. So every time I click that buy button and I see this income amount go up, it motivates me to keep clicking buy. And now with my new tenets of investing, that I cannot cannibalize my portfolio to inflation, It motivates me to find safe, reliable dividend payers who grow their dividend. So it's just, I don't know how growth investing would motivate me. Maybe it would motivate me in a different way when I just see my account value going up, but I also see my account value going up with dividend investing, just not as much, but hey, it's still going up. So just kind of keep that in mind when it comes to investing. You just want to have an open mind, do as much research as you can. There is some investing strategy that will speak to you and it will just naturally draw you to it. That's probably the one that you should go with because that's the one that you're going to be motivated enough to do without anybody having to tell you, without anybody having to try to, without you losing focus. So whatever attracts you to something, whatever you're attracted to naturally, you're going to do naturally. So if that's dividend investing, if that's investing in covered call funds, that's investing in ETFs, whatever it is, just do that because you're going to come out better than if you had not invested at all. All right. And one more thing, I know I also have another ticker, a new ticker in here. It's a SCHD. So everybody knows about SCHD. It's just a dividend ETF. And I want to clarify something I said in the last video as well. I said that any company that does not do one of two things, grow their dividend, have a higher dividend CAGR than SCHD, or a higher dividend yield than SCHD, I will not be investing in it. I want to clarify that it's not just SCHD, it's just dividend ETFs in general. So in general, dividend ETFs have a 3 to 4% yield, anywhere between a 2 to 4% yield, and they grow they have a dividend CAGR anywhere between 8 to 10%. So if a company does not beat general dividend investing, does not beat general dividend ETF CAGRs and yields, I'm not investing in it. It doesn't have to just be SCHD. I'm just personally, I like SCHD. That's the dividend ETF that I chose to invest in. And one more thing I want to say about SCHD is that I know a lot of people, which is crazy, but recently a lot of people have just kind of, I don't want to say turned on SCHD, but they've been, just talking a lot of trash about SCHD. The same people who were praising it last year now making videos about, maybe they're just clickbait content videos about SCHD myths, SCHD red flags, sell all your SCHD, whatever those clickbait titles are. I just want to say if your SCHD is a dividend compounder, so it's not for some kind of quick trade. When you put your money in SCHD, you're trying to have your money compound on itself at, I believe the average is a double digit CAGR. So you're not going to have these crazy run ups in price with SCHD. They don't hold those tech stocks like other ETFs do. SCHD wants to, I believe, to be in SCHD, you have to be they're just looking for reliable dividend payers and dividend growers. And then they pass on that dividend growth and dividend payment onto you. So if you're looking for a large run up in price, you're only going to really get that with tech stocks. SCHD does not hold a lot of tech stocks because tech stocks don't pay dividend. I think there's like a minimum yield that is required to be in SCHD, and I believe it's over 1%. And most of those tech stocks, if they do pay a dividend at all, are paying like a 0.5%, 0.6%, 0.2345. They're not paying even a 1% dividend yield. So you're not going to get those crazy price run-ups with SCHD. You will get reliable dividend growth, dividend compounded growth, and you will get reliable, slow, and steady price appreciation. It just won't be super quick. I mean, they have investment vehicles if you want that. QQQM, they have those investment vehicles if you want that. But I don't understand the this attack that's recently happening on SCHD that I'm seeing on YouTube. Nobody was complaining about SCHD last year. Nobody was complaining about SCHD a couple months ago during Liberation Day when the stock market was down 15%, but SCHD was only down 5%. Nobody was complaining about it then. So that's also, kind of keep that in mind. You don't want to ebb and flow based off what other people say or what YouTubers say, what influencers say. Just kind of fortify your mind and kind of just reinforce your own beliefs, your own research into your mind as you go through your investing journey. So what you also notice on this video, I do have a thumbnail now, so I'm getting better at editing. I'm getting better at doing some different I got like this Adobe cloud, whatever editing software, the stuff they have now. So I'm getting better at editing. So you will see a thumbnail on here for the first time. I may go back and edit and put some thumbnails on my old videos too, but well, as I get better at editing and doing stuff like that, I'll make these videos more aesthetically pleasing. But that's all for today. Thank you. I appreciate you tuning in, and I'll catch you in the next video.